Dear students, knowledge seekers and learners, welcome to lecture 2 of week 2 wherein we are going to talk about financial stability. In today's lecture, we are going to talk about and start with meaning of financial stability followed by the importance of stability. After that, we'll try to understand the difference that arises between financial stability and financial development. After that, we will try to understand the different sources of instability, followed by systemic risk and contagion effect. Subsequently, we will try to learn about the indicators of stability as well as role of regulators in maintaining stability. In the end, we'll try to understand a case study that is based on global financial crisis of 2008, and then we will highlight the challenges in Indian context with respect to financial stability. Let us now start with the meaning of financial stability. Financial stability refers to a condition where the financial system operates efficiently and withstand shocks. This is very important to understand because efficiently operating is one of the characteristics and requirement financial stability. Also, we cannot isolate an economy from financial shocks, but the financial stability means that the economy and the financial market is in such a condition that it is able to absorb the shock. What are the different issues and characteristics that are linked with a stable system, that is a stable financial system? The first is a stable financial system allocates resources effectively. That is, it sends financial resources where it is required. The second important characteristic is that a stable financial system manages risks. Now, risk management does not involve and does not mean just transferring the risk. It means mitigating risk by sharing of the risk between different stakeholders. Another characteristic of a stable system is that it continues functioning during disturbances. Whenever there are disturbances, shocks, panic in the financial markets, or some kind of crisis, the financial system responds, and the financial stability is an indicator that financial system is also working. Thus, financial stability ensures continuity of financial intermediation. A question arises that what is the core idea of stability? Why we are going for stability? What is the problem with instability? Now, we know, and up till now whatever we have discussed clearly indicates that financial system face risk. It also faces uncertainty as well as external shocks. We know that an economy responds and it also communicates with the rest of the world. So we have, say for example, Indian economy. Now there are different sectors. The household sector is there, firms are there, government sector is there. But this Indian economy also interact with the rest of the world because it is part of the world. So this is rest of the world, which is known as an external sector. Now, when it is an external sector, what does it mean is that this external sector will always bring external shocks. So, if something is happening, say for example, here in America, it will also impact India because India is part of the world and India is interacting with the rest of the world. So, the core idea is that because financial system face these three major issues, that is risk, uncertainty and external shocks, it needs to be stable or stabilized so that it can sustain these problems and challenges. Thus, stability in terms of financial system implies shock absorption, continuity of operations, no hindrance should be there, they should not stop at once, and maintenance of confidence of the different stakeholders in the financial system. The core idea of stability is thus about resilience, that is putting and fighting back when things are in shock, when the financial system is collapsing or things are going down, and not just risk elimination. Another question arises that why financial stability matters. So there are four key answers to this question. The first is financial stability maintains trust in financial institutions, and the whole financial system can fall within a small period of time if people, investors and stakeholders start losing trust in the financial institutions. Financial stability also prevents disruptions in credit flow. That is also another indicator. Financial stability also protects savings and investments. Financial stability matters because it supports long-term economic growth as well. Instability can trigger economy-wide crisis, and therefore financial stability matters a lot. Dear students, knowledge seekers and learners, let us now try to differentiate between financial stability and financial development. The basis is focus. From the parameter of focus, financial stability refers to safety and resilience, while financial development's focus is on growth and expansion. With respect to the parameter of risk, financial stability has controlled risk, while financial development, in this the risk may go up because we are looking towards a longer period of time. With respect to objective, financial stability prevents the crisis, and in terms of financial development, it expands the access. Thus, it is important that financial stability and financial development both should be balanced, and the approach should be balanced, and that is the essential part of financial stability as well as financial development. Let us now focus on the different sources of financial instability. The first is excessive credit expansion. If credit is available in abundance, then the value of money goes down, which becomes a problem for the economy to manage things. Asset price bubbles, the stock exchanges that reflect the asset pricing, they are skyrocketing. However, there is no real growth in the economy. Such a scenario is known as the asset price bubbles. In addition to this, weaker regulation is also a source of financial stability. If regulations are weak, it means that misuse of funds, frauds, misappropriation, all these things are bound to happen. And if that happens in the economy, in the financial system, then the confidence and the trust of the people in financial system also goes down. Therefore, this is also one of the important sources. High leverage, that is the combination of the fixed cost and the operating cost, that is also one of the problems and challenge. And external shocks such as global crisis, or what we are seeing today, that the Strait of Hormuz is creating a problem, that is also an external shock. Thus, risks often build up silently, and these silent risks can be very dangerous, and they can bring huge financial instability in a financial sector. Let us now try to understand and discuss systematic risk. Systematic risk is the risk that affects the entire financial system, not just the individual institutions. These risks are caused by interconnected institutions, sometimes known as the contagion effect, the market failures, and the domino effect The domino effect is the copycat effect. Systematic risk is very important to be controlled and to be understood. Failure of one institution under systematic risk can impact the whole financial system. Dear students, knowledge seekers and learners, now we are going to discuss a very important term, that is financial contagion. Financial contagion is relatively a new term that is used in financial system, but it is very important. Financial contagion means spread of financial problems from one institution or market to other institutions or market. The word contagion is used in epidemic diseases. Also, it was used in pandemic, which means immediate spread of something. So, contagion effect means suppose we have a country A and we have a country B, we have a country C. Now, today the word is interdependent. So, A is having trading relations with B, B is having with C, C is also having interconnectedness with A. So, these linkages are there. Suppose a kind of crisis happens in B country. Because A and C are linked with B country, the impact will also be on A and C. The more two countries are integrated, the more financial contagion can be seen. So it is very risky and it needs to be curtailed and controlled in order to, restrict this spreading of crisis from one country to another country. Generally, a financial contagion is triggered by panic, loss of confidence, and interlinkages. Financial contagion converts local problems into systematic risk. Let us now try to deal and understand the types of financial risks. The first is credit risk, second is market risk, third is liquidity risk, and fourth is operational risk. The credit risk is whenever a country, a person, or an economy or an institution takes debt from somewhere. Now, this debt already creates some kind of risk, the risk of default. So, this is credit. Second, market risk. Whenever we are into market, we are doing business, there are bound to be some failure, that is market risk. Liquidity risk, if you want to convert something into cash, ready cash, then there can be some risk. And operational risk refers to the day-to-day operations. Now, it is very important to manage these risks for bringing financial stability in the financial system. Let us now try to understand the indicators of financial stability. The first indicator is low non-performing assets. The second indicator is strong capital adequacy. The third indicator is stable inflation. The fourth is adequate liquidity, and all these indicators reflect the systems, the financial systems, the health. Whether financial system is healthy, it is budding, it is growing, or it is struggling with different problems. NPA are the non-performing assets. These are those loans and advances which a commercial bank has given to people, but the people are not repaying it. So after some time they can become the non-performing assets. So if non-performing assets, the money which is into non-performing assets is less or it is declining over a period of time, then it is a good indicator of financial stability. Similarly, strong capital adequacy. This capital adequacy ratio and norms of Reserve Bank of India is there. If the capital adequacy is maintained, the proper capital is maintained in the entity, then also the financial stability is proved with that. Stable inflation, controlling and managing inflation is very important to maintain the purchasing power of money or to adjust the return which is being given by the stock market. Therefore, this is also a very interesting and important concept. And the adequate necessary cash flow liquidity is also another important factor. Let us now try to see the role of regulation in stability. Regulation brings stability through control, transparency, integrity. Regulation controls excessive risk taking and keeps monitoring, and they can, you know, bring to notice of the government officials about those companies that are taking excessive risk. It ensures transparency in the sense that all stakeholders they can get the necessary information from the company, and it protects the financial system's integrity by not overlapping things. Dear students, knowledge seekers and learners, let us now talk about the role of central bank. In Indian financial system, the central bank is Reserve Bank of India, that is RBI. So Reserve Bank of India as a central bank in Indian financial system controls money supply. Second, it maintains financial stability. Third, it acts as lender of last resort. And Reserve Bank of India as central bank also supervises banks and financial institutions. Thus, central bank, that is Reserve Bank of India, is the central pillar of financial stability in India. However, RBI is not just one single regulator. There are also other regulators that are performing some other specific functions. We will be talking about and discussing the role of other regulators. Let us start with SEBI, that is Securities and Exchange Board of India, which controls the capital markets. IRDAI, the Insurance Regulatory and Development Authority of India, which monitors the insurance sector, and these regulators ensure sector specific stability and investor protection. Not only this, other regulators are very important because they protect investors, particularly to the minority investors as well as policy holders. Let us now try to discuss and delve into a case study, that is global financial crisis. Global financial crisis, there is a background. There was a time when there was excessive lending in US housing market, because of which there was a rise in subprime mortgage, that is loan which is given for buying a house. Financial institutions took high risk in the sense that they started giving loan easily to the people who wanted to buy a house, and credit rating agencies also facilitated and had given good ratings to the people who didn't deserve that. What triggered a crisis which after that spread all over the world, that houses pricing started to collapse because everybody was easily getting a loan. So there was no rent increment, there was also no, the resale price was also not going up. So borrowers who have borrowed money to buy a home, they default. Now what happened after this whole scenario? The major institutions, they failed. For example, the Lehman Brothers, this institution failed. Credit markets started to froze, the returns were literally stopped, companies collapsed, and global financial contagion, which we have studied, financial contagion, the concept of contagion, started to spread. That is, countries that were connected to United States of America, and United States of America being a G7 country, most of the countries were associated with it, and because of that, the global financial contagion started to spread all over the world. Because of that, there was severe impact on banking system all over the world. There was severe impact on stock markets all over the world, and global economy also went into a shock. So the global economic and financial crisis of 2008, which we have discussed in a very brief, the case inside is that there was lack of regulation and excessive risk taking was happening in giving loans, which caused financial instability. Also, there was the financial systems are now interconnected, which amplified the crisis. Also, this demonstrates importance of risk management, strong regulation, and systemic oversight. Financial instability can quickly become a global economic crisis. Therefore, this needs to be controlled and taken care of seriously. Financial stability in India. India has a regulated and supervised system. The key features of India's regulated and supervised system includes it has a strong central bank, that is Reserve Bank of India. There are multiple regulators that have specific and specialized tasks. For example, SEBI, IRDI, etc. We have making gradual reforms in financial sector in India. For example, from physical holding of the shares, we have moved to the equity shares by NSDL. So, financial stability always maintains despite global uncertainty. The focus should be to maintain financial stability even in times of crisis so as to reap the benefits in the future. Dear students, knowledge seekers and learners, there are also certain challenges to financial stability in India. The rising non-performing assets in banking sector is a concern. NBFC vulnerabilities, that is non-banking financial companies vulnerabilities, is also an issue. Global financial shocks. From time to time, the economic crisis like East Asian crisis 1997, Greece crisis 2013, all these crises, they bring shocks in the global economy which needs to be taken care of. Cyber risk in digital finance. This is a modern and contemporary challenge that needs to be mitigated, and therefore stability is required, and this requires continuous monitoring of the Indian financial system. Let us now discuss the trade-off, which is a fundamental economic concept between growth versus stability. Let us understand with an example. We have two countries A and B. So one country is looking towards growth, another country is looking towards stability. Now what happens is that for growth you have to take some risk. If more growth you require, you need to take some risk. Sometimes what countries do, that they take excessive risk for growth, but they do not realize that forecasting, which is the basis of expecting more growth and expansion, that may not reap those fruits. On the other hand, stability is that if you are more stable, you take less risk. So there needs to be a trade-off between growth and stability. That how much growth and how much stability. How much resources should grow for growth, how much should go for stability. So rapid financial expansion can increase risk, but it is not always bad for that. What needs to be balanced is there should be innovation and there should be proper and strict regulation. Obviously, regulation does not mean that there should be more and more number of laws. We all know that too much regulation slows growth, too little increases risk. So there should be a balanced approach in terms of regulation that companies have to follow. What is the policy approach to stability? Prudential regulation, regulations that are preemptive in nature, that can alert the system that these financial fraud or problems are going to arise. Policy approach to stability. Policy approach to stability means that there should be prudential, that is preemptive regulations that should work. Similarly, risk monitoring should be there. There should be financial sector reforms that can perform the job, as well as strengthening of the institutions and markets. The financial stability is very important and it should be maintained through proactive policy measures. Dear students, knowledge seekers and learners, let us now summarize whatever we have discussed in today's lecture. We have discussed and highlighted that financial stability ensures resilience and continuity. We also have realized that the systemic risk and contagious effects are the likely key threats to the Indian financial system. There is also important takeaway is that regulation and central banks play critical roles in Indian financial system. And last but not the least, there are real world crises that highlight the importance of financial stability. Dear students, thank you very much for being with me in this session.